Online real estate circles make it sound simple. Buy a single building, get handed 4 sets of keys, and instantly become a wealthy landlord. The mechanics actually do start out quite accessible. The Federal Housing Administration allows qualified buyers to purchase residential properties with up to 4 units. Backed by the government, this requires a down payment of just 3.5%. But there is a catch to all of this massive leverage. The buyer has to physically live in one of those units as their primary residence. This diagram illustrates the strategy known as house hacking. The owner claims one specific unit to live in and places renters in the other 3. Every dollar collected from those tenants flows straight into a central bucket to pay the property's total monthly mortgage. Looking closely at Miami-Dade, Broward, and Palm Beach counties for 2026, the FHA loan limits now stretch up to $1.28 million for a 4-unit property. Combine a multi-million-dollar ceiling with a tiny down payment, and buyers naturally zero in on fourplexes to maximize their scale. But stepping up from a 2-unit duplex to a 3- or 4-unit building triggers a severe shift in FHA underwriting rules. Focusing solely on unit count without accounting for these specific hurdles usually leads to a late-stage loan denial, even if the buyer's finances are strong. The safest entry point for new investors is almost always the duplex. It uses the exact same 3.5% down payment structure, but operates under standard, straightforward residential underwriting rules. That translates to easier financing approvals, a lower total purchase price, and managing just one other household. The trade-off is a complete lack of income diversification. If your single tenant packs up and moves out, your rental income drops to 0 overnight, and you are entirely responsible for the mortgage. That risk pushes buyers toward the appeal of scaling up to 3 or 4 units. Having 3 paying tenants provides multiple rental income streams, better cash flow insulation, and faster equity growth. But buying into that scale triggers a highly restrictive, specialized FHA regulation. It is called the FHA self-sufficiency test. Adding those extra units shifts the lender's focus away from your personal credit history and places the entire burden of loan approval squarely on the property's standalone math. The test issues a very strict mandate for any 3- or 4-unit property financed through FHA. Lenders evaluate using this formula. 75% of the gross market rent must cover the full monthly mortgage. For an $8,500 mortgage, the building needs $11,333 in rent. If actual rent is lower, the FHA loan is instantly stopped. The Federal Housing Administration enforces this to protect themselves from default risk. They demand proof that the building can survive on its own if things go wrong. From the buyer's side of the desk, this logic often feels deeply confusing. You can sit down with an 800 credit score, 0 personal debt, and a high-paying W-2 job, and still receive a hard denial from the underwriter. The rejection has absolutely nothing to do with your personal merit. It happens solely because the local rent numbers failed that specific fraction. Inexperienced buyers waste months touring and bidding on fourplexes because they assume their strong personal credit will bridge the gap. In the specialized world of 3- to 4-unit FHA loans, the property's raw cash flow potential matters far more than your personal financial strength. This specific math creates a brutal bottleneck when applied to the realities of the 2026 South Florida real estate market. This diagram illustrates the local pressure. Severe property taxes and skyrocketing premiums for flood and wind insurance aggressively inflate the mortgage payment block. That forces the required market rent threshold dangerously out of reach. Local buyers see South Florida's massive population growth and high rental demand and mistakenly assume a property will automatically be profitable. Relying on gross rent provides an incomplete picture of the investment. The building's viability is determined by the net operating income, the cash remaining after taxes, insurance, and maintenance are settled. This leaves FHA buyers looking at 2 distinct paths, depending on their goals and risk tolerance. If you are a first-time house hacker who wants to minimize risk, lacks massive capital reserves, and wants to spend less time managing tenants, strictly target a duplex. You bypass the self-sufficiency test entirely and secure a much more manageable entry into landlording. But if you are highly focused on scalability, rapid wealth generation, and squeezing maximum return out of your FHA loan, pursue the triplex or fourplex. Just know it requires a paranoid approach to underwriting local insurance costs and a willingness to submit dozens of offers before finding one deal where the math actually works. Regardless of which path you choose, everything starts with getting pre-approved by a lender who deeply understands the specific multifamily nuances of the South Florida market. Earnest, sustainable investment success depends on verifying the local math before committing to a property, ensuring the numbers work long after the initial purchase.